Hello, everyone. On behalf of HSBC, we welcome you to this webinar, Establishing Direct Access to China Bond Market, Why and What to Look Forward to. I'm Hazel Lai. I look after sales and client management for Hong Kong and Taiwan security services in HSBC. In this webinar, you will hear industry experts and investor pioneers to share insight on accessing China's CIBM via Bond Connect. Without further ado, I will introduce our first speaker, Singh. Erin is an economist from HSBC Research, and she will share the latest on the China economic landscape. Erin, please.
My name is Singh, and I'm a Greater China economist here at HSBC, where I've been looking at China's economy over the last few years. And prior to this, I was an economist at the US Department of Commerce. So in terms of how we're thinking about China's economy, it's helpful to take a step back and look at what was happening towards the tail end of last year. And at that point, China has already been seeing some growth pressures. The government had noted these are the so-called three pressures, which includes a demand contraction, so from soft consumption, pressures from supply chain disruptions, which were pushing up producer prices, as well as, on the global scale, there were also supply chain disruptions pushing up the global commodity prices as well. And of course, some weakened business sentiment given continued uncertainties in the global backdrop as well as the domestic backdrop. So in light of this, policymakers had actually started to shift their policy stance towards more easing at the end of last year. They had implemented broad-based RRR cuts, as well as lowering their policy rate, the one-year LPR. They also front-loaded special local government bond issuance in the amount of about 1.5 trillion RMB, which had not been done in the prior year. So it also lended itself to more proactive fiscal policy. And as a result, we actually saw that in the beginning of this year, this has really fed into pretty strong activity across the board. So we saw that there was pretty strong growth in investment, particularly in manufacturing investment, as well as in seeing a pickup in infrastructure investment, while there was still healthy industrial production. But that being said, as we have been moving into March, the headwinds have been picking up. And this has been stemming both from the domestic side as well as the external side. So for the external side, of course, there's been rising geopolitical tensions in Europe, and that's led to more global supply chain disruptions, pushing up a lot of the commodity prices in energy, in metals, and also in key components such as in fertilizer. So it's really been quite broad-based. So this is going to, of course, impact higher inflationary pressures globally. And because of this, this is also going to lead to softer than expected global demand. And because of the higher inflation pressures, we've also seen that a number of central banks across the world have started to tighten their monetary policy in order to help anchor inflationary pressures here. All this means that global demand can be softer this year than in the coming quarters than what we had initially saw in 2021, where exports were actually a pretty strong driver for growth. So aside from the external side, domestically, there's still a lot of pressures, particularly coming from the recent Omicron outbreak. In China, the Omicron outbreak had really spread in March, and it's continued into April. So in March, we had, Shenzhen and the province of Jilin. They both implemented lockdowns in order to help limit the spread. Now, at that point, in March, these lockdowns were still relatively on a shorter time period, such as in Shenzhen, it was only about 1 week of full lockdown. But as we've seen that cases have become more widespread, and there's been more concerns that the Omicron outbreak is actually becoming more of a growth headwind than initially expected. So in March, the impact of these Omicron outbreaks had already fed through into the monthly activity data. We saw declines in services production growth as well as in retail sales. So really there has been a noticeable impact. And coming into April, it's quite clear that the impact is likely to be larger as cases have accelerated. So the Omicron outbreak, it's at the highest number of daily cases, well over 20,000 daily cases. And in terms of the implementation of COVID strategy, it seems that China's very much sticking with its relatively strict containment policies. So this means that it's going to be impacting both consumption as well as production. Now, in light of this, we think that with the growth headwinds kind of accelerating, and we see that with the growth headwinds likely to be stronger in April, what does this mean in terms of the policy response, and how can China really move to address these downward headwinds? So I think from our view, it's going to become because from our view, because of the from our view, this is going to come from from a pretty comprehensive easing package on all fronts. At this year's MPC meeting, they had also stated that they wanted growth to reach a pretty ambitious target of 5.5%, but given the current pressures on growth, both externally and domestically, there's going to be more need for decisive easing now and in the coming months to help growth to move back on track. On the monetary policy side, the PBOC has already started to move they moved with the RRR cut in April. So they announced that they would do a 25 basis point cut. However, this was a little bit smaller than what market participants had expected. Typically, they move at about 50 to 100 basis points. So why the more measured pace? Well, in our view, this is probably one because the PBOC has usually been pretty cautious. They want to prevent financial risk, prevent too much debt accumulating too quickly. So they don't want to flood the markets with too much liquidity. Additionally, we think that because of the high amount of uncertainty in China's economy, facing China's economy right now, they want to preserve some ammunition in case things do become worse. And also, if we actually look at the credit data in the first few months, in the first quarter of this year, it was actually quite strong already. So it gave them a little bit more leeway to not act quite as aggressively in this April cut. But that being said, we still think that there is going to be more monetary policy measures to come. Following the 25 basis points in April, we think that there could be 3 more cuts in the first half of this year. There could also be more policy rate cuts. So we're expecting 10 basis point cut to key policy rates such as the 1-year LPR as well as the 1-year MLF. And besides these besides these triple R cuts and policy cuts, we also see more liquidity injections, so they can continue to roll over their medium-term lending facilities and inject more open market operations. They're also going to probably implement more targeted policies, so this can help improve the capital allocation within the credit, because we think that one of the key pressures in the economy has also come from a slowdown in the property sector as a result of them trying to kind of prevent overheating. But because of this, we've seen double-digit declines in a lot of the leading indicators, such as property sales this year. And because property accounts for about a quarter of China's GDP, it's really imperative that they prevent a hard landing in this sector. But that being said, the overarching strategy towards the property sector is to let houses be for living in, and not to fuel more speculation. So we do think that they're going to be using more targeted policies, such as increasing the relending quotas for new growth areas like green investment, as well as for technology innovation. And we also think that they can further implement more window guidance to kind of channel more credit to go towards these areas, which can, of course, help with the capital allocation. But it's not just going to be from monetary policy. So on the whole, we do see more monetary policy easing to come, which should help lead to a modest pickup in the aggregate financing or total social financing growth to about 11.3% this year. But we think that there's also going to be more fiscal policy, which is going to play a large role in supporting growth as well. We also think that the PBOC has the policy space to continue to ease. For one, even though there are rising global commodity prices as a result of geopolitical tensions, most of this is going to be limited to producer price inflation. So we think that this could, edge up PPI on a month-on-month basis in the coming months, but we think that on the whole, the transmission from PPI over to CPI has stayed relatively limited. Because of the continued uncertainty from COVID-19, the consumption recovery has actually been fairly gradual, and that's actually lended itself to relatively subdued CPI inflation. And right now, even though there has been pretty high PPI, CPI has remained well below the PBOC's target of around 3%. And we think that because we still have Omicron uncertainties right now, and these are probably going to we'll probably still see some residual impact on consumer sentiment this year. We think that the consumption recovery is likely to be only fairly gradual this year. So we think that as a whole, core CPI could stay relatively low, likely staying under 1.5% this year, which of course does give more policy space for the PBOC to continue to ease and support economic growth this year. So for fiscal policy, this year, the government has already front-loaded special local government bond issuance to the amount of 1.5 trillion. This has already started to feed through into infrastructure investment, which we think is going to continue to be a driver for growth this year. Overall, the special local government bond issuance quota has been about the same level as last year, so still relatively supportive. But we do think that there's going to infrastructure investment is going to come from a mix of both infrastructure investment for new infrastructure such as ICT development, 5G, EV vehicles, as well as your more traditional projects such as building out your transportation networks, as well as water conservancy projects. Now, there's also going to be more tax cuts implemented this year. This is more than double than what we saw last year. So this year they have announced that they're going to do 2.5 trillion of tax cuts and fee reductions with a focus on small enterprises as well as innovative enterprises. And this can help firms to reduce their costs as well as to fuel and support more growth in help to support growth through more proactive fiscal policy. They've also announced that of this 2.5 trillion, they're going to have value-added tax rebates. So this is more like funneling direct fiscal support, giving more cash back to the firms, which can also help them to kind of tide out the current storms that they're facing. But of course, it's not just about these monetary and fiscal policies. We also think that from policy standpoint of property sector as well as the overall regulatory environment, we're going to see more adjustments to help support growth. So property, as I mentioned, is facing significant headwinds as a result of kind of tightened policy stance in the recent years, and that's really started to feed into some of the data at the beginning of this year. So we think that in order to help prevent a hard landing, there needs to be more support to increase household demand for the property sector. If we actually look at the if we look at the credit data, we actually saw that in February, we saw the first contraction in medium to long-term household lending. So this was actually pretty significant because it shows that the impact on household demand was actually quite significant as well. So in order to help kind of fuel some, in order to help stabilize the sector a bit, we've been seeing that on the fringes, there have been more cities that have been lowering their mortgage rates, and they've also been implementing some relaxation in the household eligibility requirements, such as allowing for people relaxing some of the hukou requirements for those who want to purchase housing. But they've also been raising the loan to value ratio of to help bring more credit for households as well. But it's also going to come not just from supporting household demand, but to also allow for more supply of credit to go to the healthy developers. So we think that the PBOC will implement more window guidance to allow more credit to flow to healthy developers, which should in turn help to stabilize the sector a bit more. But that being said, overall, we think because this overarching stance of housing should be for living in rather than for speculation, we're not expecting a V-shaped recovery. Most of these easing policies are more to help stabilize the sector's recovery. Now, in addition to the property sector adjustments, we think that there will also be more leeway in terms of how they implement regulatory policies. So we saw that last year there have been a number of a number of regulatory policies that were quite disruptive for the industries, ranging from things like after-school tutoring to video gaming. But in order to help prevent kind of a disorderly disruption, we think that regulatory policy, while as a whole, they're likely to continue because China has this goal to move towards common prosperity, to continue in its de-risking campaign. So that means that regulations are going to continue to be implemented, but we do think that they're going to be more implemented in a more transparent and gradual manner. And we saw that comments from Liu He in March's Financial Stability Committee meeting that there should be better coordination and better communication with capital market participants when they are implementing such new policies. We also think that on the green side, last year this had also caused some impact on growth, where we saw that there were electricity shortages because of pretty ambitious decarbonization targets. But this year, we actually see that decarbonization targets, there's been a little bit more flexibility coming through. So as opposed to having annual targets, they actually had removed this in this year's MPC meeting. And I think that this does show that China is trying to balance its more near-term growth pressures with its longer-term decarbonization goals. So right now, they have maintained, of course, their more longer-term targets of peak carbon emissions by 2030 and carbon neutrality by 2060. But the road to get there has allowed for a little bit more leeway to take into account the local situation. But in all, we do think that the overall regulatory implementation is going to be a little bit more gradual and transparent, so as to limit the downside impact on growth. So taken all together, we do think that there are a lot of near-term headwinds. The growth pressures from the soft expectation of softer global growth, as well as domestic headwinds from the Omicron virus, as well as the softer property sector are putting more pressure on growth in the near term. But this comprehensive policy strategy of easing on all fronts, including from monetary side, fiscal side, some easing in property-related measures, as well as in the regulatory side. This should help growth to stabilize as we head into the coming quarters. So in conjunction with better containment of expectations of hopefully better in conjunction with better containment of the Omicron virus to help limit the impact on the consumption and production side there, we also think that the policy stimulus will start to filter through, and this should help allow growth to pick up towards the latter half of this year. But of course, in all, we think that the challenge is there, and but the path towards their growth target does need more policy easing on all fronts. Thank you.
Thank you, Erin, for your presentation on China economy. Next section is going to be a short presentation by Phoebe Leung and I on the trends and development of the China bond market and Bond Connect. Phoebe is Senior Vice President, Head of Sales and Marketing from the Bond Connect Company Limited. I may kick off with a generic bond market overview before passing on to Phoebe, who will speak about the scheme development. HSBC, as a Bond Connect custodian, is excited to see the growth firsthand in the CIBM market and all of the drivers behind. We have a large market share across all China access channels. For CIBM, our market share is around 1/3. And for Bond Connect, we are the #1 custodian in terms of accounts opened since the launch of Bond Connect and also in 2021. We see both sides and the growth stories are fairly consistent. Let me provide you with more context from a custodian angle. Next slide, please. The scale of investment by overseas institutions in China bond market is growing year on year. In January 2019, bonds held by overseas institutions amounted to RMB 1.75 trillion, and that's about 2% of the balance of China bond market. And by the end of March this year, the bonds held by overseas institutions have almost reached RMB 3.9 trillion, although slightly come off from RMB 4 trillion at the end of last year. Is still more than twice that in 2019, and is roughly accounting for about 3.3% of the total bonds of CIBM. Major reasons driving the growth are, #1, index inclusion. So if we can move on to the next slide. As you can see from the slide, we started from the earlier Bloomberg Markets Global Aggregate Index inclusion through to the recent FTSE World Government Bond Index. The amount of AUM tracking these indices is around $6.25 trillion, and depending on the respective inclusion factors, there are billions of inflow going into the China market to keep investments on track with the indices. Second reason for growth is about the extent of the relaxation and the enhancement of the schemes that help clear the roadblocks for investors. Regulators have taken in the feedback from the investors to further simplify the registration process, extended the cash bond trading hours, extended the the bond trading settlement cycle, and also enabled third-party FX under Bond Connect. Last but not least will be on the tax clarifications. So there was temporary exemption on corporate income tax and also for the value-added tax of the coupon interest income received by overseas institutions in the China bond market. And this is going to be extended to the end of 2025. This all gives more clarity to investors. So in a nutshell, easier access and better clarity have all contributed to the growth of China bond market investments. So what more to expect in the China bond market? There are some common themes asked by the investors. #1, it will be on the expansion of the product scope. So bond repo has always been the ask by the investors and is under review by PBOC. The other one is about infrastructure connectivity between CIBM and exchange-traded bond market. And this is pretty topical at the moment. As some of you may know, CIBM and exchange-traded bond markets are two different markets in China. So unless investors have QFII today, they won't be able to access two markets via one single setup. But with the infrastructure connectivity, it actually enables investors to leverage on their existing setup while expanding their China bond investment universe. For instance, CIBM investors can ride on their current setup to invest into the CIBM bonds plus exchange-traded bonds, and vice versa. And exchange market investors can invest in exchange-traded bonds plus eligible bonds in the CIBM. So connectivity, this infrastructure connectivity I meant, it really gives convenience and wider access for the investors. We have already received numerous queries from multiple investors. And regarding these bond market interconnectivity, we have been closely following up with market infrastructures to get more market insights. The best estimate we have is the implementation details may be released as soon as May, June, and the launch time could potentially be around second half of this year. What it means to Bond Connect investors is, in principle, they can also access the exchange-traded bond market via this interconnectivity channel, although initial stage may only enable settlement cycle for T+0. Now we await more implementation details to be released to around the qualified requirements, account structure, and the trading and settlement arrangement, etc. And HSBC will continue to stay close contact with the market infrastructure on this subject and advise our clients. With these, I'm going to hand over to Phoebe, who will talk about the Bond Connect specifics. Phoebe, please.
Thank you very much, Hazel, for your kind introduction earlier. Now, the overview of the CIBM definitely set a solid theme to my session for Bond Connect. So greetings, my friends and audiences from Southeast Asia. I hope everyone is staying safe and healthy in these unusual times, and really, hopefully, we'll be able to network in person, not in the very far future. Now, today is a very special occasion for us, and I'm sure that some of our audiences have previously engaged in our large public events as we discuss about the China bond market and its development. It's absolutely our pleasure to join hands with our wonderful partner, HSBC, like Hazel yourself, in this forum, where audiences and speakers can all share our views and exchange ideas. So whether you're already in the market, already studying about the market, or just waiting to be enlightened in this session, please don't be shy with your thoughts today. Now, in recent years, China has unquestionably become the destination for strategic allocation among investors, not only just tactical, because of its low volatility, its strong return, and diversification value among major local currency markets. The RMB currency itself has in fact been strongly supported in the past year by China's solid current account and portfolio inflows. During the recent RMB move, the quick reaction of PBOC to lower our FX reserve ratio was very well received by a lot of investors. Now, the strong fundamental of its economy and the prospects of further opening up definitely continues to serve as a backbone of many global real money's long-term investment into China. Next slide, please. So in the last 20 years, there are multiple asset schemes launched to increasingly embrace international capital into the onshore bond market, including RQF, QF, and CIBM Direct. They all have their strengths at a time, and of course constraints as well, because they were developed at the very rather early stage of RMB internationalization. As time goes by, it is increasingly evident that the investor profile is going more diverse and more sophisticated. And here comes Bond Connect. We were tasked to build an asset scheme that is able to provide the most investor-friendly bridge to the CIBM and not be afraid to start internationalizing China's market infrastructure. As such, we were given a long-term mission to increase foreign holdings from 1.6% before we were launched to a goal of 15%. With the launch of Bond Connect, investors went from being uncertain about repatriation to being able to sweep any cash exposure immediately to offshore now. They are able to use electronic trading, they have freedom to pick their international custodian like HSBC, and shortening their onboarding time from months to weeks using our e-filing. Now, Northbound Bond Connect integrates a DM architecture with an international trading and custody infrastructure base. So essentially, the investors can operate under their very own international practice and habits. But how is that easily done? So Bond Connect is categorized by its trading link and settlement link. Next slide, please. So first of all, I'll start very quickly with just trading. So Bond Connect is the first access route that directly utilizes international platforms like TradeWeb, Bloomberg, or Market Access. It interfaces directly with CFAT's trading system, which is the onshore fixed income trading platform. This means that investors can now gain a full autonomy in their trading without the need of agents' input like the old schemes. This eliminates human errors or delays that's possible in the older schemes. And to trade, investors can conduct RFQ with 56 onshore market makers spanning across banks and securities. Now, moving on to our settlement link. Investors are not required to open accounts within China for their bond holdings for Bond Connect. Instead, they hold their CIBM bonds through the global custodians or local Hong Kong-based CMU custodians through a nominee account structure under HKMA CMU. Now, CMU as a nominee maintains securities accounts with the two onshore depositories. Now, with this simple arrangement, investors are assured of beneficiary ownership for their bonds and also eliminated the need for them to contract with an onshore settlement agent who operate under PRC laws. So all cash accounts and operational flows now are maintained offshore. So now you see, Bond Connect essentially gives you a route to trade China as if you're in China while you're actually outside China. To put everything into context, whether it's application process, bond ownership structure, or trading protocols, Bond Connect has become very well received because it's more direct, it's easier, and it's faster. Next slide. So over years, international investors have gradually become more seasoned participants in the onshore market. As such, Bond Connect is also in the forefront to cater for the evolving investor behavior. So as Hazel also mentioned previously, for example, in the past years, we have achieved the inclusion of Chinese securities in the 3 global bond index providers. We also extended settlement cycles, trading hours, and we're also venturing more into the primary market and FX services. And recently, more importantly, as Hazel has already mentioned, we also extended tax exemption until 2025. Next slide. So all of the efforts that I have mentioned have translated into very solid momentum that explains why Bond Connect has become a mainstream asset scheme in just 5 years. First of all, in terms of accounts opened, on a year-on-year basis, the number of Bond Connect accounts gave a 40% solid rise to over 3,600 today. And that's across close to 800 global entities that have already been onboarded, including banks, AMs, pension, insurance, sovereigns, securities, hedge funds, etc. And on the next slide, we will be able to see that Bond Connect is definitely a global phenomenon. You can clearly see Bond Connect's jurisdiction coverage from a more holistic angle here, effectively where your peers are coming from. So we have penetrated 3 additional markets last year, including Brazil, Norway, and Kazakhstan, adding to our investor coverage totaling 37 global jurisdictions. Now, among the new accounts in just the last 12 months, we are seeing a very solid global profile of investors, especially in the asset management companies. 30% of the new accounts came from AMs in Japan, obviously because of FTSE, 15% from US, 11% from Luxembourg, and the rest from Hong Kong, Ireland, UK, Australia, etc. Interest from Malaysia, in particular from the Southeast Asian region, is also on the rise. These investors, including the AMs, are bringing in considerable inflows from global pension funds, sovereign names, and insurance. So demand from these asset owners remain extremely high with a solid pipeline. Not to mention, we also have increasing interest from global private banks, wealth management, family office, to progressively diversify our investor profile even more. Now, on the next slide, apart from a strong magnitude of investor adoption, for those audiences that already follow us, the momentum of trading volume from global investors on Bond Connect has recently become a spotlight of attention. We have broken records after records in 2021, ending with a yearly ADT, average daily trading volume, of 26 billion RMB last year. And this year, we took this to another level. We landed at a historical high in January with a monthly ADT of 41 billion RMB and a single day record of close to 70 billion RMB on January 19th. With this momentum, I would not be surprised if we close this year seeing a much stronger number, especially if we're coupled with more market and Bond Connect enhancements this year. So next slide. At the current stage, investors are mostly still focused on CGB, policy banks, and some more sophisticated investors may start looking into financials, credits, including ABS and green bonds as well already. Liquidity in the onshore bonds are mostly focused in the 1 to 10 years normally, and investors have largely been focused on the 7 to 10 year recently, or the very short end, sometimes as a cash management tool. And on the next slide, so now with all the enhancements of the market and greater magnitude of international participation, the foreign investor holding for China bonds rose by 50% in the last 3 years to 3.88 trillion RMB today, as Hazel mentioned. In CGBs alone, I want to add this number, foreign holdings represent 12% of the overall market from only roughly 4% when we were launched. So this is exactly the reason why a lot of real money investors argue that RMB assets is still very much under-owned. And coupled with China's economic restructuring undergoing at the moment, there is still immense room to develop. So with our long-term goal of 15% international participation, there is still a lot of initiatives waiting to be done to further equip our investors with a complete suite of investment and hedging instruments in the long term, and which may already be in the pipeline. So this brings the end of my presentation. So the opening up of the China market is, definitely happening at a speed that is never seen before. So I really hope that my session is able to set the scene for you why China is one of the most, if not the most compelling story in the market. Thank you.
I hope all of you have some ideas of the opportunity that Bond Connect presents. Let's now hear from the other speakers about why and what to look forward to in the China bond market. In addition to Phoebe on panel, we are pleased to have Esther Tell, Senior Director, Fixed Income from Arvin Kwang Asset Management, and Ricky Lee, Head of FICC Sales from HSBC China Global Markets to join us. Esther is one of the few pioneers from Southeast Asia to enter into the China bond market, and she's going to share her experience of investing in the CIBM from an investor angle. And Ricky will also highlight his journey supporting foreign investors to manage their bond investments. So my very first question, which is a warm-up question, I'm going to address and direct this to Phoebe. So first of all, how do investors choose between CIBM Direct and Bond Connect? Any key differences, and will that be merged in future?
Thank you very much, Hazel. So I think there are a number of key factors that investors really consider when they are looking, whether they should be choosing Bond Connect or whether they should be choosing CIBM Direct. I think the first thing that they'll consider is really in terms of convenience. So as I've mentioned in my previous presentation, so I think the custodian structure and the legal framework that the investors will be operating in, should they choose CIBM Direct or Bond Connect, is actually very essential. So for example, some of the global AMs, for example, they may actually choose Bond Connect because they can utilize their existing global custodian model instead of needing to sign up with an extra bond settlement agent in onshore under the TRC laws. So I think this kind of convenience is one of the main considerations as well. So the second one, just then I mentioned about, the legal framework, which I want to elaborate on. So with Bond Connect, essentially you're operating under international laws because it is something that is being regulated by CFAX through Bond Connect in Hong Kong market. And essentially, for example, your cash account, your bond account is actually all offshore. As I've mentioned, on your cash account, because it's being held in the offshore market, it is being swept immediately from the onshore market anytime, for example, if you receive any coupon payments or when you have any sale proceeds. And your bond accounts being held under the nominee account structure with CMU is also a big plus for some of the investors, considering that they know that they have the beneficiary ownership. And I think the third consideration will be on the trading side, because for Bond Connect, we allow for electronic trading, and it's actually quite easy for investors to use Bloomberg, TradeWeb, or market access to access directly. But I think, when investors choose between CIBM Direct and Bond Connect as well, there's also one other thing that they will need to consider, because CIBM Direct, obviously, it allows for repo trading for some of the RMB settlement banks or central banks. So if those banks or central banks, if they are comfortable in signing up for NAFMI Repo Master Agreement and they really meet the service, they may really consider that. But of course, repo is also subject to PBOC window guidance, which they have really paused before. So I think these are some of the very objective considerations from the Bond Connect and CIBM Direct perspective. But I think, as part of the Connect program, we are really built on the core value that, all investment and hedging instruments need to work as closely as possible to international practice. So in long term, we will definitely be heading towards the direction in all of our enhancements. So I think, all in all with these considerations, I think it's an easy decision for global real money investors like AMs, insurance, pension, securities to go for Bond Connect. And that is also being reflected with, the numbers of investors we have seen being onboarded. So we have, around 3,600 now across 798 entities versus CIBM Direct model, which is only about 514. So I think this kind of considerations will be in the investor's mind when they are looking at the different asset schemes.
Yeah, certainly. And I think investors will also consider their own situation to decide which access. And then the growth of Bond Connect, of course, has, is also a pretty good evidence about its popularity.
Absolutely.
Yeah. And my next question is actually to Esther. So what's your first-hand experience from an investor perspective to invest into China CIBM? So if you can tell us more about your thought process behind and how do you find the application process overall?
Thank you, Hazel, and thanks very much for having me today. I just want to share that I think back in 2018 is when we decided to start exploring investing into the CIBM market. And, I think we were one of the first asset managers, like you mentioned, that started this process in Malaysia. And I think what made us decide to invest in the China bond market was, of course, the size of the bond market at that time being the third largest. And we know that, China will be included in major bond indexes. And also, we expect foreign inflows and opening up of the capital accounts over the long term. The other consideration is, of course, the low correlation of China bond market with other global markets, as well as the currency appreciation aspect that we see. So I think the decision for us to make is whether we want to go through CIBM Direct or Bond Connect. At the end of the day, we chose Bond Connect. I think some of the reasons Phoebe has mentioned earlier as well, on the ease of trading on it. I think that was one of the major consideration. As Afin Huang, we used Bloomberg AIMS as our trading platform, and at that time, Bloomberg was onboarding TradeWeb or Bond Connect into the system, and that will make us trade in a one platform basis is much easier. The other advantage is, of course, the nominee structure and all the bond settlement is done offshore rather than onshore. We see that it's much easier and also in line with our global custodian, system that we have. And I think the other consideration was the account opening process itself. It was rather straightforward, unlike the earlier or other process where we have quota or you have to submit an investment plan. With Bond Connect, there's no such needs for that. So, and also the shorter process of opening account is our consideration. Yeah, so I think all that, it was a very good experience, and Phoebe and her team has been very helpful along, helping us along the way. It did take us a little bit of time to get it going because of the Bloomberg. At that point, we are the first investor, I think, for asset managers in Malaysia, and Bloomberg was, took a while to onboard Malaysian clients. So at the end, we managed to get it up and running back in 2020, and we started our first investment into CIBM in 2020.
Thank you, Esther, for your view. I have a follow-up question on that. Since you went through the process of comparing between the direct CIBM and the Bond Connect, do you find it more costly to maintain a Bond Connect channel?
Yeah, so I know that we do pay a little bit on trading charges to Bloomberg for using the platform, but I think it's not too much, and it depends how much you trade. Currently, I would say that our exposure to the China bond market now is around 8 to 12% of our Asian portfolios. It's quite a significant part because we have built up that position over the last 2 years. So I think it's a function of how active we are trading in the market. But besides that, I don't think there's any other cost. Can correct me if I'm wrong. Thanks.
It's always good to hear from an investor perspective, and it's a much easier sales pitch for us to quote the other investors. My next question I'm going to address and direct to both Ricky and Esther. This is about how easy do you find it to hedge for your CIBM investments? Maybe I will start with Esther first.
So at the moment, most of our, renminbi exposure is unhedged. So most of our funds in Malaysia are ringgit-based fund, and we take a view that over the long term, we want to have exposure to the currency, the yuan, and hence we are not really actively hedging. But we can have the ability to hedge using CNH, on the offshore market. So, we have done some of that, but we are not really actively hedging our WAM position at the moment.
Understand. And Ricky, how about you? How do you see it from the sales side of the business?
Yeah, sure. Thanks, Hazel. So for FX hedging, I think offshore investors, a lot of them, I think they are not currency hedged. However, if they do want to hedge their currency, they can choose to hedge using the offshore CNH, of course, without any restriction, because CNH is not regulated by onshore regulators. But if they want to hedge their currency using the onshore CNY, it's also doable. Basically, there are two options. One is to go via the so-called PBOC 159 article, which allows the renminbi participating banks to offer onshore deliverable CNY to offshore investors. And then the product in scope under the PBOC 159, including the FX spot, forward swaps, cross-currency swap, and even the CNY FX options. And the access channel in scope includes the Bond Connect, CIBM Direct, as well as Stock Connect, as well as RQC. So it's a scheme under the PBOC 159. Alternatively, Bond Connect investors can hedge their FX with their primary FX bank, i.e. the CMU participating or their custodian bank in Hong Kong. So basically, under this scheme, you can hedge your CNY exposure using the onshore CNY rate, but with an offshore renminbi FX bank. So it's easier from documentation perspective. You can write on your existing e-stock with the offshore renminbi bank like hsbc Hong Kong or hsbc London, for example. So that's pretty easy, and investors have the options. To talk about the other interest rate hedging, Bond Connect investor can also hedge their interest rate risk using the NDIRS, non-deliverable interest rate swap. For CIBM investors, they can also hedge their interest rate risk using the onshore IRS as well. So basically, the bond yields and the cross-currency swap, you can use the cross-currency swap to hedge your currency exposure as well as the interest rate exposure. So basically, you can use the derivatives to generate an asset swap to capture the excess return and convert your CNY bond investment into a dollar equivalent return. That's it for me. Thank you.
Thanks, Ricky. And do you foresee any enhancements that's upcoming for the hedging?
Well, I think the Bond Connect eventually they will be able to open more onshore deliverable hedging. Currently, Bond Connect investor can do the FX hedging using the onshore renminbi rates. But going forward, it might open the onshore IRS to Bond Connect investor as well. Another very popular instrument for hedging is the Treasury future. Currently, it's only available for QF investor, not available for CIBM Direct or Bond Connect investor. But it's a very effective hedging tool, especially for China rates investors. It's very correlated with the China government bond yield performance. So going forward, I'm looking forward to more hedging tools like the onshore IRS or the Treasury future, CGB future, open to Bond Connect investor as well.
Yeah, and keep us updated about all the market insights that you hear. I'm sure investors are very keen on that. My next question is about the current China market volatility and how do we see the impact to the investors' appetite? Maybe I'll start with Ricky this time before I turn to Esther and Phoebe.
Sure. For me, I think international investors traded or invested in China bond market for three main reasons. First of all, China onshore bonds are underpriced in the global bond indices. There are three, basically, as you know, but not for long with the acceleration of China's financial market internationalization. So the first and foremost reason must be the index inclusion. It's not only appeals to passive investors, but also it generates a benchmark for the active investors as well. So the second reason for China is a good way to diversify the portfolio. I think Esther and Phoebe mentioned earlier as well. It's driven by the fact that China has relatively independent monetary policy. Thus, China onshore bonds are more closely reflecting the domestic factors and have exhibited low correlation with the other global developed market as well as the emerging market. So it's very good diversification. And thirdly, is the relative value. As you know, the China bonds used to offer a higher yield relatively to other emerging market and global developed markets. However, as the Sino-US government bond yield curve is inverted as of today, as you know, the US Treasury 10 years almost 3%, while the Chinese government bonds is nearly 2.8%. So the yield advantage has diminished, frankly. However, the diversification is still there. If you and you consider global investor, a lot of them are long-term investors, right? So not the short-term arbitrageurs, right? And from the CCDC and the Shanghai Clearinghouse custodian data, we also see overseas investors offloaded their bond holdings earlier this year, especially by end of February and in March. So for instance, in March, we do see offshore investors reduce their China bond holdings by renminbi more than 110 billion, which is around 18 billion US dollar equivalent. This is followed by a reduction of renminbi 80 billion, or equivalent 13 billion US reduction in February. So we think narrowing the spread between the China and the US difference played a key role. And of course, the geopolitical risk since the end of February also played another role. So we see a lot of the offshore flows, especially from the asset managers, has been reducing their China bond position since February. So from our observation, the starting flow came down a bit or relieved a bit in April compared to March. But overall, we didn't see a strong buy-in from asset manager given the further inverting or divergent yield trend between the China and US. So overall, in sum, we do see good inflow from the offshore AM might remain sidelined at current moment. But in general, on the other hand, we do see offshore sovereign investors, including the central banks, sovereign wealth funds, they are generally still buying. So that's our observation.
Thanks, Ricky. And I'm going to turn to Esther. Does what Ricky said resonate with how you feel and what you see as an investor and as a manager?
Yeah, absolutely. I think earlier I mentioned that diversification was one of the reasons why we, are embarking on this investment into the China bond market. And the low correlation between Chinese bond market and other parts of the world is one of the reasons that we think China makes a good long-term investment. So like what Ricky shared, like if I look at the CGB, the China government bonds, the yields were up only around 6 to 7 basis points year to date, compared to US Treasuries, which is up close to 140 basis points year to date. And as we all know, other parts of the world, even in Malaysia, where our central bank is quite dovish, we are not seeing major rate hikes in Malaysia, but our government bond yields have risen about 75 basis points year to date. So that tells us that, if I look at my portfolio, the China government bonds is definitely an outperformer this year. So I think where the volatility comes from is on the credit market, where it is mainly driven by the property sector, given the distress we are seeing in that segment of the market, and that has definitely hurt sentiment and flows, right? So I think there is a major growing pain, I would say, with the China bond market, even though it is a very large market in the world. It's only a few years ago where the credit in China are allowed to default, to say. So I think it's a sign of the market trying to mature, and investors now have to look at the credit fundamental very closely, and also to look at price differentiation and rating differentiation. And I think that volatility will likely to continue in the near term until we see some stabilization and more government policy easing for that sector. But I would say that over the long term, the focus on government bonds as policy banks, those are the part that will provide that stability. Whereas if you're going into the credit market, then you need to have a very strong credit research capabilities on the ground, knowledge about these issuers, as well as the dynamics of the market. I think it's similar with other emerging markets. If you're investing in Malaysia as a foreign investors, you may not get as much color and you need to have relationship with onshore banks, right? To get to know the issuer and do your homework. And I think that will continue as we grow and build our capabilities. But over the long term, we still believe that there will be more inflows into the China bond market. I agree with Ricky that in the last few months, we are seeing outflows. And for Apin Huang as well, we have started taking profits on some of our CGB holdings because they have done very well since we entered in 2020 in terms of currency as well as, the bond yields performance. So we are taking some off the table. And like what Ricky mentioned as well, the valuation is another consideration, given US Treasury yields and even other countries like the Australian government bonds. You can get yields that are closer to 3 or above 3% for 10 years. So there is a rotation at play at the moment.
Thank you, Esther. And how about you, Phoebe?
I think I totally echo with what Ricky and Esther has mentioned. I think essentially, China is a long-term play. I think that's a key message that we're bringing through. There will definitely be short volatility, whether it's in rates or in FX. I mean, in February, it was the start of the whole geopolitical tension in the global market, same as March, in addition to the MPC meeting that actually caused a lot of the different investors going a bit sidelined. And then in April, of course, in the second half, it was the FX play. But I think, like I mentioned earlier, I think, January, we still saw the, highest trading volume in records for Bond Connect with inflows. Obviously, February, March, April, we did see a little bit of outflow, and echoing what Ricky has mentioned. But we do think that is actually from some spillover effects from offshore as well, because obviously in the past 3 months, the Asian high yield bond fund or the Asian bond funds in general, they have seen excessive outflow. And the onshore China bond funds, from what I saw from all the market research, is actually the last to take the hit in a much smaller magnitude. And essentially in the past 3 months, I think the only area or bond portfolio that we're seeing some inflow were actually some ESG portfolios. So I think, I totally echo with them. I think, there will be volatility in the short tenor, but I think it doesn't really stop investors from feeling that, China is still a long-term investment. From what I mentioned earlier, China assets is still very much under-owned. So I think that's what everyone is looking at as well.
Thanks, Phoebe. I think you pretty much answered my next question. So what are the benefits for investors to start planning now? Pretty much to your point, the China bonds are still under-owned by foreign investors. Yeah. I may slightly change my question a little bit. Is now the right time, given all of the volatility that we see and recognize? Or as you said, it's a longer-term play. Yes, it's a good time.
I think it's a short to medium to long-term play. I'll summarize it in 3 points. I mean, our speakers mentioned diversification value, is low volatility, is resilient to external shocks. And, RMB is also added to the basket of the SDR currencies back then in, I think, 2016. And, like what Ricky has mentioned, the global central banks, they are also evidently hiking up on the RMB reserves. We can see from, everyone's annual reports as well. There's definitely the early bird advantage as well, riding on, the index inclusion story, because, now it's still in progress. FTSE has really only just started in October, and, China is still among the highest returns among the DMs. So I think, whether it's a short, medium, or long-term thing, it is still a right time to start now.
That's good to know. I echo the same view as well as a custodian, because it's really a longer-term play, and the earlier they plan, the earlier they will be able to capture all of the growth. Especially, we spoke about all of the future enhancements that's coming through. I think it's better to start early. And talking about enhancement, Esther, we know, we have spoken a lot on what's the future enhancements that's upcoming from myself, Phoebe, and Ricky. I pretty much want to know from you as an investor. So in addition to all of these enhancements that we spoke about, what are on your wish list as an investor? Because as a custodian and also together with BCCL and other market participants, we do the lobbying closely with the regulators and with the local market, and we do want to channel back what investors wanted to the local market in order to see them implemented. So very happy to hear from you.
Sure. I think just now Ricky has touched about that as well. I think one of the things that we are looking at is on hedging. At the moment, we can hedge our, CNH or even CNY, but I think on interest rates, we hope that we are able to hedge using IRS or Treasury futures because, more than 50% of our exposure on the CIBM is in Treasuries, right? So the ability to hedge would be fantastic. The other thing, I guess, would be on, I think there's a tax exemption for foreign investors at the moment, and that has been extended. We hope that we will continue to enjoy that tax benefit. And the other thing would be on the availability of bond prices on Bond Connect or on Bloomberg. I'm not sure whether Bond Connect can work with Bloomberg for us to be able to see more quotes, especially for corporate bonds. That will be very helpful. I think as with many local currency markets, that is always a challenge to see more active quotes from brokers and the trading liquidity on the corporate bonds as well. Yeah, so I think those are the key things that we hope we can see from Bond Connect in the future. But I must comment and say that Bond Connect has made tremendous progress and has continued to work towards making it easier for investors to access the onshore market directly. So I think that is really good work by Bond Connect. Thank you.
Thanks very much, Esther. Hey, Hazel, I just want to double confirm with everyone, okay? This is not pre-rehearsed.
Yeah, this is not. We know that. It's unplanned totally. And probably one last question, given the time, and it will be good to get a roundup from everyone. So starting from Esther, what will be the advice that you can give to investors who are considering to enter into CIBM? Because our audience for today, they are from the local market, and they are also learning about the China market, considering whether they should go in, how they should go in. So I'm sure they will find it very valuable to hear from you who have gone through this firsthand.
Sure. Yeah, I think as Asian-based investors, we cannot ignore the China onshore market. It is the second largest bond market in the world, and it will continue to grow strongly in the next 5 to 10 years. So I think as an investor, you need to provide that's access to our clients to be able to have access to that market. And hence, it is very crucial to get started now. For us, we are not new to the China bond market because we started investing in the US dollar market since 2010. And from there, we have started to build a credit research team that is familiar with China. But I would say for investors who are getting started now, you can start with looking at the CGBs or the government bonds and also the policy banks, because in terms of credit risk, those would be the lowest on the spectrum, and getting familiarized with the technicals of the market, the macroeconomics of it, and slowly move towards the credit market. I think it's important to build a strong relationship with onshore banks and banks like HSBC and other banks that have information and access to issuers in that market. Another thing would be that there's also going to be more and more foreign issuers that are tapping the onshore market. There's another avenue that foreign investors can look at because we are familiar with some of these big global names that are issuing in the market. So you can also participate in those issuances as well. But I think that the point is that it is one of the largest market. We see tremendous opportunity over the long term. So we think it's important that investors get on board. In Affin Hwang, we are also doing our part to inform and educate our clients, our institutional investors, as well as retail investors about the diversification benefits and the long-term yuan, exposure, for example. So just to share as well, in 2021, we have launched our first renminbi bond fund in Malaysia to give access to our Malaysian investors into the onshore market. So I think, we can't ignore this market anymore.
Thank you, Esther, for your insight. May I turn to you, Ricky?
Yeah, sure. Thanks, Esther. I totally agree. So for offshore investors where you have no experience in China now, you should start with rates. As you know, that the foreign holdings in CGB market is already more than 10%. The maximum peak should be around 11% before it drops to 10% as of latest. And also, I think credit market has great potential. There are credit bonds trading in China in both interbank market as well as the exchange market. So basically, for Bond Connect and CIBM Direct, currently you have access to the interbank market. And going forward, there's an initiative ongoing, which is being intensively discussed, which allows the Bond Connect investors to access the exchange market as well, which we call the Interbank and Exchange Interconnectivity Program. I'm sure Hazel will share your details in another separate section. And also the hedging tools like the CNY IRS, the CNY repo, the bond lending, the bond forward, etc. These hedging tools will be gradually available for Bond Connect investors in the coming days as well. And also, I would like to remind investors that the devil always lies in the details. So start prepare earlier and get us involved. HSBC is here to help if you need anything. Thank you.
Thanks, Ricky. Last but not least, Phoebe.
I'll keep it very short. So I think I echo what Ricky has said. Do it early. So that is the key advice that I give investors, because it's always better to have a free option on the table, especially among all the uncertainties on a macro basis, whether it's geopolitical, whether it's market related. And also another advice will be more vocal in what you need to really further equip yourself, whether it's on your investment process, how you trade, how you settle, and how you hedge. Because this is a time when we really listen to investors, because your opinions really matter, because we will take it in and reflect it to our onshore regulator counterparts as well. So you really want to be part of this internationalization story. It really doesn't happen every day, and you are in to make history. So do it early.
Thank you, Phoebe. And one last statement from me will be, if you're interested in the CIBM market, just find the partners to speak with, and that will be BCCL and HSBC.